welcome to our April 2023 market update. Thank you so much for being here. We'll get started in just a moment.
I'm Emily, the communication coordinator here at Eagle Wealth Management, and today we're going to hear from Eagle Wealth practicing partner Mat Hunnicutt and Robert Meckstroth, a senior portfolio manager at City National Rochdale. A couple quick announcements. Your microphones are muted and your cameras are off. So if you have any questions, please type them into that Q&A box you see down on the bottom panel. It's the second option. And at the end of the webinar, we'll do our best to answer all your questions. A recording of this webinar will be sent out next Monday in our newsletter. All right, with that, I'm going to pass it over to Matt.
Welcome, everyone. We are just about a week after the close of the first quarter of 2023. What an interesting quarter it was. Off to a new quarter this week and different data and what a difference a week makes. So this week, we're going to cover just an overall economic update, review of the last quarter of or the first quarter of 2023, Q1. We're going to cover a little bit about inflation, look at the outlook that's there with what happened last quarter, what's projected to happen, or Robert and City National Rochdale's thoughts on that. And then we're going to look at just do a discussion of outlooks on the interest rates going forward and for the rest of 2023. And of course, we'll wrap up with some questions that we've got from the audience, and Robert and Chad and I will answer anything that we can. So without further ado, Robert, we'll turn it over to you.
Thank you so much, Matt and Emily, and thanks so much, everyone, for taking some time out of your day this afternoon to go through the markets and the economy with us today. Sometimes we do these and there might be a few things to talk about. This time, almost overwhelming the amount of stuff we can talk about today in terms of the markets and the economy. So I'm going to start by sharing my screen here, and you're going to be able to see, hopefully, the presentation. And I'm not going to go through every one of these bullet points, but I want to highlight just a couple of them. One is economic outlook, higher for longer thesis intact. This is going to be a big part of our discussion today, because the story of interest rates going up, the Fed tightening, and inflation being high, that hasn't gone away despite some other headlines. And inflation continues to run fairly hot. It's come down a bit, which we'll talk about, but all the signs to us say that the Fed has to keep interest rates high. It's going to be a big part of our outlook, this idea that interest rates have to stay higher for longer. What that means is recession risk, even though it might be modestly lowered to 70%, 70% chance of a recession is a high number. We're looking at 70 to 75% chance of a recession, but thankfully that recession is likely to be mild. That recession word gets thrown around a lot, but not all recessions are created equal. We'll talk about that. And then we'll talk a little bit about investment strategy. How do you invest during a time when markets are as volatile as this? We'll dive into that as well. So the first page I'm going to show is what I call our crystal ball page. What is our forecast for the end of the year? It's not always easy to forecast what interest rates, what the economy, what inflation are going to do. But notice the red squares, very bold red squares, are our answer to where inflation might end up. Couple of things to note. One is we show the headline CPI here. That is the number that is most quoted when you hear news on inflation. But we also have the core CPI. The difference between the two inflation statistics is one excludes food and energy. And when the Fed is looking at inflation, they typically are most concerned about the core CPI, because food and energy prices can be volatile, sometimes for reasons that are not associated with what's going on here in the US. So stripping them out can be a better view of where domestic inflation is going. So there's both good news and bad news on the inflation. One is it's a noticeable decline in inflation from where we ended last year. And we're kind of still in that range, 5 to 6% inflation. it's coming down, and that's a good thing. Weakness in the economy is going to continue to put pressure on prices. The bad news is core CPI that's still above 3% is above the Fed's goal. The Fed wants inflation down to 2.5% would be okay, but we're projecting north of 3% for core CPI. And that directly impacts our interest rate forecast for year end. And sometimes we like to look at what other managers are doing, what other firms are doing in terms of their forecasting. Sometimes our views will be right in line with the market, and sometimes they won't. In this case, our views are actually well above what the market is pricing in for interest rates. There are going to be some ramifications for that. But our view is that because inflation is still sticky, because the economy fundamentally is still okay, the Fed is going to keep interest rates longer because their goal is to bring inflation down. Now, the opposite argument to this that some firms have is, well, because of what happened to Silicon Valley Bank. And we'll take some questions on that and get into the banking situation on this webinar today. But some market participants say because of the shock to the system that has happened, the Fed is not going to be able to go through with this higher for longer interest rates, and they're going to have to bring interest rates down as the economy struggles. There's some logic to that view, but our view of a mild recession being the worst case scenario would support keeping interest rates at least at the levels they're at now, because we're approaching 5 to 5.25 on the range. We're basically pricing in one more rate hike this year and done. And we are not factoring in any rate cuts this year. So that has ramifications when it comes to investments. That makes bonds maybe a little more attractive when rates are higher. It makes very aggressive type stocks maybe unattractive that would benefit from lower interest rates. But the final crystal ball forecast here is economic growth. Our view is that economic growth, is potentially going to be anywhere from -1% to +1%. And if I had to vote, I'd probably take the negative, kind of 0.5% to 1%, consistent with a mild recession. You can see corporate profit growth falls as well. There's a chance it doesn't, but most likely companies are going to see diminished profitability. Now, diminished profitability still means profitability. That's something I hear people getting confused about, because when you look at big, high-quality companies, especially in the US, their profitability may be down a little bit, but it's still very, very solid. So sticking with really high-quality companies in this type of market is never a bad idea. So bottom line, this visual, some of you may have seen this visual before, basically shows, recession odds here. This shows up to 75% recession odds, but 65% being the mild recession scenario. So we are likely to hit recession in 2023, but as we just talked about, it's likely to be more of a mild variety. And what does a mild recession mean? Well, it means that the economy is slowing at a much lower rate than a normal to major recession. But it often means that companies are maintaining high levels of profitability. Earnings growth is coming down, but you're still maintaining profitability. What that means is you're not going to see a surge in unemployment that would come from a major recession. So there are headlines about labor market stress right now. There are layoffs. I'll show some job figures that go into just how strong the labor market still is. It's actually somewhat decent news that the labor market is weakening a bit, because that helps put pressure on inflation. So another favorite slide of ours that many of you who are repeat webinar listeners have seen is our speedometers page, 6 to 9 month forward-looking view of the economic data. And there are no green indicators on the page. It's been a couple months since we've seen a green indicator, and this is consistent with the story that we've told. We have a weakening economy that is in the process of weakening, continuing to weaken. And we're not out of the woods when it comes to inflation yet. So inflation has improved. We saw the year-end inflation stats in the 5 to 6% range, down from close to double digits at some points in 2022. But the inflation numbers have been sticky. It's just barely gotten into the yellow. that reiterates the idea that the Fed is going to have to continue to be fairly tight when it comes to monetary policy. They're going to have to keep interest rates high. And the higher interest rates go, or if they stay high, it's almost like squeezing the economy in a way. You're putting pressure on the economy. When you're putting pressure on the economy, there is all likelihood that things are going to start breaking as interest rates go up. And if we were doing this call a month ago, we'd be talking about, well, maybe nothing really has broken yet in the economy outside of very high growth tech stocks. And then Silicon Valley Bank happened. Something did break in the economy that was triggered by a combination of poor management, sector exposure, but also interest rates going up. If interest rates hadn't gone up to the level that they did, the flaws in Silicon Valley Bank would not have been unearthed, and we might not have had this, at least small banking crisis for now. Again, we'll kind of talk about more of this as we go through the presentation. When it comes to the banking crisis in the last few weeks, crisis might even be the wrong word at this point, because from what everything looks like, the crisis is isolated to just a few banks. And because of the government's response, and I'm not saying it was necessarily the best government moves over time in the banking sector, but the response to basically say that anyone that had cash in these failed banks has access to their cash Monday morning immediately was a message that was a strong signal that you don't have to take your cash out of a small or regional bank with the fear that you might not have access to your cash. So that step alone from the government kind of reassured bank depositors, investors. Now, the regional banking sector itself is still under some pressure. And a lot of that pressure is not necessarily because there's risk that these banks are going to fail. The pressure on the banking stock prices is more of these banks are probably going to be subject to more regulation. Silicon Valley Bank was not big enough to be subject to the same scrutiny that the major banks are subject to. And that turned out to be an issue because it might not have had the same risks if it was subject to that. But on the other hand of that, other side of that coin, if you do subject small and regional banks to the same onerous regulations as big banks, can they be profitable enough to survive? That is what is weighing the stock prices of a lot of these banks. So what you need to know today is that the banking sector is still healthy. The Fed was a great source of liquidity for banks. And you may see one or two, the first republics of the world, still be in some trouble, but I don't think this is a broad systematic risk right now in the economy. There are a lot of risks out there, but this one is probably not one of them. Now, a couple of the potential scenarios here. I do say normal recession would have to come with a significant increase in unemployment. I think that's the major difference between mild recession and normal recession. You have to have a massive increase in unemployment to get the major recession. And this chart right here is probably one of my favorite charts to look at. This shows the case for mild recession. Why are we so convinced that a major recession is not in the cards? Well, this is one of the reasons. Look at major recessions since 2000, dot-com bust, great financial crisis, pandemic. And look at this chart. It shows job openings minus available workers. And when you see job openings minus available workers, there's a big deficit. A lot more people looking for work than there are jobs open during big recessions. And look at the difference right now. Historically high amount of job openings. 4 million excess job openings as of this report. Now, this is starting to weaken. We just got a report this week that open jobs have fallen under 10 million for the first time in a couple of years. So there are signs that the labor market is weakening, but we still have excess jobs. Unemployment is still sub 4%. So even if unemployment were to go up to, I think the Fed is projecting 4.5% unemployment to 5%, that level is not consistent with what happened in major recessions. Unemployment has spiked higher. So fundamentally, that's probably the strongest reason that we're not going to get a major recession, because if people are employed, people have money to spend. And the second chart, if I had to pick my second favorite one, it's the debt service burden, because you can go out and find some headlines that'll say, well, credit card debt is at an all-time high right now. And those are accurate headlines. But what they're not taking into account is, what is that debt relative to the total asset base that households have? And even though debt is coming up, what this chart shows is that household balance sheets are still at a very healthy level, consistent with pretty much the entire 2010 to present household balance sheet level, nothing close to 2007. So I hear some arguments, this is 2007 again with excess consumer debt. Not even close. In fact, households remain in very good shape from a debt service level. Now, I'm not going to cover the other charts in spirit of time, but one of the things I do want to cover is the slowdown in spending and how this is going to start helping inflation. The right side of this chart shows disposable income per capita, so excess cash available to spend, and the left side shows spending. The trend line here shows that, as a country, our per capita income kind of has trended in a positive direction, slowly making more money over time. And then look at what happened in the COVID pandemic. Boom, government assistance, extended benefits, stimulus, all of that amounted to the biggest increase in personal income really ever. And that triggered this excessive amount of spending on the left side of this chart. Real personal spending just spiked. And this is the dynamic that helped lead to the inflation situation we're in. So I do think if you had to go back, and it's easier said than done, and say, was it all the correct policy moves to deploy all of that cash to raise incomes? Probably was a little much, looking back on it. I mean, it's easy to say it now. I mean, I remember March 2020. It was not a very scary time. We didn't know how bad the pandemic was going to be. So, it's easy to criticize policy looking back, but definitely you can see the income increase we had led to this surge in spending. Now, housing market is a great example of what happens when interest rates go up. When interest rates go up fast. Look at mortgage rates, 30-year mortgage, historically low heading into this year. Interest rates go up, or heading into 2022, I should say. Interest rates go up, 30-year mortgage goes from 3% to 7%. What does that do to new and existing home sales? 37% decline. So you can see the immediate impact of rising interest rates on the housing market. Now, again, we talk about, is this 2007 again, a 37% decline in housing? And we don't think so. You're not seeing really any foreclosure or short sale activity across the country. Most homeowners, despite decline in sales, still have significant equity in their home from purchases. And even people that bought homes at higher levels, kind of at the peak of the housing market, most of those buyers were buying with very low interest rates. If you locked in a mortgage at 3% and now rates are 7%, even if you may have overpaid for your home, your monthly payment is still not necessarily that bad at the low interest rate. So you're not in a dire situation where you got to sell your house at a loss. So those are some fundamental differences on top of just very low inventory still. We're not overbuilt from a single family home perspective. We may be a little bit overbuilt on multifamily, but we'll get into that when we get to inflation. So I won't spend too much time on this, but this kind of breaks down the labor market. I mentioned job openings are far exceeding the amount of unemployed workers here on the left. This is a very strong labor market. In fact, maybe a little stronger than the Fed wants. The Fed would like to see job openings be closer to unemployed workers. And you can see where a lot of these job openings are. Education and health, leisure and hospitality, and transportation, big amounts of job openings. What's funny is as we as consumers pull back on spending, we've pulled back almost all of our spending on the goods side of things and not necessarily on the services side. So check out inflation right now. It's fascinating to look at inflation in terms of goods and services. Goods inflation, which was peaking at double digits last year, has completely fallen off a cliff and is basically down at the levels that the Fed would want to see, under 2%. But look at services activities. Services activities not only have continued to go up, but they really haven't cooled down at all. And services includes, travel and restaurants and housing is part of the services activity. Basically, not physical goods goes into the services category, and there hasn't been any relief there. That's one of the reasons that inflation has been so sticky, is that the goods inflation has already fallen off a cliff. It's just becoming much, much tougher to get the services inflation down. So here's our forecast CPI. I like to look at the year-over-year CPI here, the gray line. What we're looking at is, a pretty big drop in the second half of the year for inflation. Not necessarily right away, but why do we have kind of conviction that this is going to come down? Well, I think there's one part of the inflation index, the housing market, that is the most likely to fall in the second half of the year. Housing is about 40% of the CPI, and a big part of that is rents. When we talk about rents, rent inflation typically is lagging, meaning that rents could be falling in real time and it doesn't show up in the data. Why is that? Well, to some extent, it's the nature of how leases are locked in. You lock in a lease for 12 months. Most landlords aren't doing you any favors and cutting your price in the middle of a period you've already agreed to. Yet, if the market is calling for lower rents, when that lease expires, you get to re-up at a lower price. And we're starting to see that. Multifamily construction, we might be properly built, maybe a little overly built, and you're likely to see rents start to fall in the second half of the year. It's at least my forecast. Now, this is why I mentioned the Fed is focused on prices for services other than housing, because housing, we talked about, I think, is going to come down. We're going to see housing prices come down. You see it here. Look at rental prices starting to fall, this blue line. Ownership costs are starting to fall. That's going to start to show up in the numbers. But look at this. I'm going to really, blow everyone's mind with another inflation term, and that's called super core inflation. So core inflation is what the Fed looks at. Super core inflation is no food, no energy, and no housing. So we just talked about the housing is going to start to fall. But notice the super core inflation isn't really falling when you take housing out. And why is that? Well, again, it's just consumers here in the US are in decent enough shape. And despite investor sentiment being down, I can tell you, I'm taking my kids on a spring break trip next week. There is no discounts to be had out there. And I don't think we're going to be having rows ourselves on the plane. I think it's going to be pretty darn full. And you see it in the data. Americans are spending money on travel, spending money on hotels, restaurants, concerts, sporting events. There are no discounts to be had out there. I can tell you on the sporting event side too, Warriors tickets are not getting any cheaper. Almost unaffordable, actually. But anyway, it just shows we still have an inflation problem. This all goes back to the Fed, and it all goes back to interest rates. And here's the Fed policy. The Fed remains hawkish. We have the projection going up to this 5.125, and we think we're going to get there. One more rate hike. That rate hike is likely to come in May. It's possible they pull it off the table, but we think that if inflation remains as sticky as it is, they will raise rates one more time, even if it means putting more pressure on the economy. And I think because the banking situation we feel is stable, the Fed feels is stable, that gives them the confidence to maybe raise rates again without thinking you're going to blow up another bank. So, more positive year expected for financial markets? I think you can have positive stocks. I just painted a negative picture We talked about recession. We talked about uncertainty, high interest rates, high inflation. All of that has been, fairly negative. But one thing I always want to remind everyone is stocks typically bottom out when overall sentiment is negative. Think about the times that stocks make bottoms. March 2009, I can tell you, it was probably the most negative sentiment in that whole great financial crisis was March 2009. And that's when stocks started to come back. When you look at the S&P 500, performance before and after GDP troughs, basically. So when GDP hits the bottom, stocks are usually have ended their fall and start to come back pretty quickly. Oftentimes, it's hard to see this in real time. You don't realize the economy's coming back until you've kind of already got 6 to 9 months in. So we always say the stock market is typically 6 to 9 months ahead of maybe where the economy is. That's the old saying, you can't really time markets. You gotta stay invested in quality stuff. Definitely you wanna manage your risk according to certain economic factors, but it's always hard to know when the stock market is gonna bottom. I hear a lot of clients saying, hey, because everything is so negative right now, let me just call me when everything looks good and I'll buy back into the stock market. If only we could do that. I definitely would probably be owning an island somewhere if we had the ability to do that. But anyway, I just want to go for a couple more slides because I really want to get to as many questions as we can by the end. But I love this slide. I just put this one in today because I got a question this morning that I really loved. Is where like, well, is all the Fed doing raising interest rates? Is that all they can do to fight inflation? Is there anything else they're doing? And there is. This is the Fed balance sheet. This is all the assets that the Fed has in their balance sheet. That hit as high as $9 trillion. When the Fed is buying assets, that's effectively loosening monetary policy. In tough times, the Fed has aggressively bought assets as a way to stimulate the economy. 2008, they got the balance sheet up to $4.5 trillion. And then the pandemic really accelerated that balance sheet from 4.5 to 9 trillion. And again, you could argue maybe this is too much. What they're executing is called quantitative tightening, meaning you can almost see this as a ladder or a set of stairs going down as the Fed is slowly unwinding the bonds that they have on the balance sheet in a very gradual way to not really spook the markets. And this is another way to help tighten financial conditions. When you tighten financial conditions, that puts more pressure on inflation. That slows down the economy. This is another tool of the Fed's toolbox. So I think a couple more slides that I want to hit on. One is the debt ceiling. The debt ceiling is something that there's a lot of talk about it early in the year. When the bank crisis hit, I haven't been hearing as much about it, but we are going to hear about it. The US is likely to run out of cash to pay the bills sometime late this summer. And when that happens, that has enormous potential for more volatility. Back when this happened, I think the best parallel to this was 2011. I don't really care about the other two periods. 2011 was the real parallel where we got to the brink of not paying the bills. S&P downgraded the US credit rating from AAA to AA, and markets were down 10+%. Important to note, 12 months after, markets were back up to kind of where they were. So I think we're going to see maybe some similarities this time around. And again, a deal could come out tomorrow and that would change this. But the more you get close to that debt ceiling kind of deadline, and we don't know exactly, there's no hard date when we're going to run out of cash, the more pressure is going to be felt in markets. But I think 12 months from now, we're going to think of this as a complete non-issue because it's a little bit of a game of chicken. Both sides don't really want to give in till there's real pressure to do it. And I think that pressure is it has to force some action. because the scenario that no action is taken and the US does not pay the bills, that's a scenario that benefits no one. So I think it's going to be uncomfortable as we get closer to the debt ceiling deadline, but I think it will get resolved in a manner that allows the US to pay the bills, or at least as the US does so well, at least kicks the can down the road another 6 to 12 months. Very likely we see that. So just to conclude, I want to talk about what happened in markets in 2022 and why this relates to everything we just talked about. So in 2022, S&P 500 was down 18.5%. This chart shows the stock market return, S&P 500, going back to 1980, 42 years of returns. You see about 3 in every 4 years are positive for stocks. The blue bars represent the calendar year return. The red dots represent how the market did during the calendar year at its worst point. So last year we were 25 down in September. We rallied back to down 18.5. Again, last year was a tough year for stocks, but not an abnormal one. You see a lot of minus 19, 18, 20s on this page. Bear markets are normal. They happen. Volatility is normal. And post big periods of volatility, things can improve rapidly, like 2009, like 2003. You see big recoveries in stocks so after these periods in many cases. We're off to a 7% start in the S&P this year, despite a major bank failing. So we could be seeing some of the same trends there. But what happened in the bond market last year was completely unprecedented. Look at the 42-year history of bond returns here. The worst year prior to 2022 was in the early 90s. We had a minus 2.9% year. Last year, minus 13%. I mean, we were setting records that we don't want to set in terms of bonds. Worst real investment grade bond performance ever. First year ever where bonds were down 2 years in a row. Never had that before. And first year ever where both stocks and bonds were down double digits. So 2022 for conservative investors was a worse year than 2008, than 2001. And it was an unprecedented financial year, basically triggered by those interest rates going down. So I know that was a lot of talking, that was a lot of information there. I just want to kind of summarize what I said, and then I'm going to turn it back over to Eagle Wealth to see what questions might have come in. In summary, mild recession scenario likely. The economy is slowing down, and the slowdown in the economy is almost intentional by the Fed because inflation is a bigger problem than a mild recession. If inflation were to linger longer, this could be the 70s and 80s all over again. And we know we don't want that period again, the financial markets. So mild recession induced by the Fed, no systematic banking crisis in the works, likely to be higher interest rates for longer based on the Fed fighting inflation and no banking crisis in the works. And that means that financial conditions may start to improve over time for stocks and bonds. There are opportunities out there. Anytime you see bonds down 13%, and some of these are high quality bonds, there's opportunities to take advantage of higher rates. So hopefully that was good information. Again, we should have ample time for any questions that might be out there. So Matt, I see you coming back on the video, so I'm going to turn it back over to you. And Matt, I think you're on mute, so.
There we go. Thank you so much, as always, for your expertise and bringing to all of our clients the research that you guys at City National Rochdale conduct and your outlook and everything. We do have a number of questions. I would say, if you're out there listening in there today, we've got time for a number of questions. We've got some that we'll just start with, right away. And I think one of the big things that we've heard come up in the office, and so I'm gonna actually take the first question, but we've had this come up with a lot of clients, Robert, is particularly a little bit of extrapolation on the banking crisis question. And the question we've had for a lot of folks is, are my money market accounts or my FDIC insured or my savings accounts at my bank safe? Can you speak to that really quickly?
Yeah, happy to speak to that. So a couple of things. One is anytime you have cash in the bank, I've gotten this question so much. If it's under 250,000, that's FDIC insured. I mean, rock solid. No matter what happens to your bank, you're having access to your cash through the insurance. Now, what happened with Silicon Valley Bank tested this because there were depositors at Silicon Valley Bank that had well in excess of the 250,000 FDIC maximum insurance amount. I mean, we're talking about companies that had billions of dollars in cash. And basically what the government had to do is they guaranteed that anyone that had cash at Silicon Valley Bank would have access to that cash basically immediately. And there's liquidity provided by the Treasury to make sure that cash was available. So the bottom line is the Fed, the government has come out and said, well, they're not going to increase the FDIC insurance right away, but they've implicitly guaranteed that cash in the bank is safe by this action. So there's no reason at all to move money out of a banking institution you have solely for the reason that you think it's going to fail. The reason to move money out of a banking institution into something else is just because of returns. One of the problems the banks have faced is, those big balances at Silicon Valley Bank, they weren't paying interest on those balances. The 2-year Treasury bond pays 4% right now. So many people are pulling cash out of the bank into savings products because when the 6-month Treasury pays you 4%, it's hard to justify keeping cash that you don't need in a bank account that pays 0. But as far as it being safe, absolutely safe having cash in a banking institution in the US.
Outstanding. And then what about money market accounts? How safe are those?
Yeah, money market accounts, I mean, think of that example I gave where, okay, you don't want cash in the bank, you want it in a Treasury bond. And what a money market fund basically is money market fund is usually your default option for cash in your brokerage account. It's basically a fund that owns a bunch of very short-term Treasury bonds. And those money market funds will pay pretty much exactly what those Treasury bonds will pay. So basically, money markets have been completely safe investments, even in a period like 2008, when all hell broke loose in the financial markets. There was 1 or 2 money markets. I mean, money market funds almost always trade at 1. They trade right at par. There were 1 or 2 that, what they say, broke the buck, meaning they went down below the $1 value, and it was temporary. There was no losses in money market funds in 2008. So I think 2008 was the ultimate stress test for some of these money market funds, because that was truly a financial crisis situation. And this time around, if you have, cash and money market funds, not only is it safe, it's probably far better than having it sit in a bank account that's not paying anything.
Great, thank you, Robert. Okay, so here's another one. With the strength of the US dollar that we've seen in recent years, what's the outlook for that and the strength of our currency versus other global currencies? And then to follow up on that, do you see a risk, or are you guys seeing a risk of the US losing reserve status?
Well, I've gotten this question a ton recently. I think there's, some headlines out there that, some Middle Eastern countries are looking to China to settle oil contracts in Chinese currency and not US. And this question kind of comes up, which says, oh, is the US dollar going to, plummet in value? The Fed has $9 trillion on the balance sheet, and we spent all this money. Our dollar is going to become worth less. Should I do anything about it? And this actually leads into a question too, because I see a question that's come in about, do I buy precious metals as part of a portfolio? And that's often one of the choices I see people making to answer this question. I don't trust the US dollar, so I'm going to put my money in gold or silver. Now, a couple of things to unpack here. One is, we often forget, currency prices. Kind of what does it mean when the US dollar weakens? Well, typically I think people I talk to think, well, when the dollar is strong, that's good for America, that's good for the US, that's going to be good for everybody. But in fact, how the world works, it almost works the opposite way. Last year, one of the big problems in the US stock market was the dollar was so strong. When the dollar is extra strong, like it was last year, it makes all of our big American companies much less competitive internationally because our products just became a lot more expensive. If you're a country that has to buy something in dollars and dollars became more expensive, you might not use a US company. You might look for a cheaper alternative. And the opposite is true when the dollar weakens. When the dollar weakens, you know, a lot of Apple products just got a lot cheaper for our international customers. And companies like Apple do 50% or more of their business outside the US. So I actually think, to me, a better hedge against dollar weakness is owning big US companies that benefit when the dollar weakens, as opposed to owning precious metals. And you know, precious metals, they do play a role. They are a hedge against uncertainty. But the reason they're tough is, especially when interest rates are higher, you don't get paid any interest owning a pile of gold or silver. I mean, they're not interest producing assets. Whereas you own a interest bearing asset, a stock that pays a dividend, for example, that stock is paying a dividend. The dollar weakens, that company might be more profitable and pay you more dividends. So that yield component makes precious metals a little tougher. The other thing that's tough about precious metals is speculation. Owning precious metals in the 70s and 80s was a completely different experience than owning them now. Back then, it was mostly physical commodities. You actually are buying into a physical purchase of gold or silver. Now, with all the ETFs out there and kind of artificial ways to trade precious metals, and the growth of China's involvement in that space, you have extreme fluctuation in prices. So the mistake I see people is saying, I'm going to allocate to gold because I want to protect my portfolio against uncertainty. When in fact, you've actually increased the risk of your portfolio by taking on a speculative asset class that can move sharply and doesn't pay you any yield. So it doesn't mean they're bad investments, but they're often ones that have a lot more risk than people think. So long answer to your question, Matt, but I think I maybe killed two birds with one stone on that.
You did, Robert. We had a question on the role that precious metals can play in portfolios. I think you answered that in the dollar outlook. So thank you very much. One thing I'll quickly point out, I think Robert addressed the housing market a lot, particularly, obviously that's here in the US. A lot of us, we've got a lot of clients here in Central Oregon, and just a reminder on that one, housing prices are local, right? So so what we may see here may be slightly different or maybe not from what we're seeing globally, but from or broadly here across the United States. But so then maybe we'll wrap up with maybe one more. Maybe we can slip two more questions in, but I've got one here. Do you see, or you guys see a role of defense stocks and defense company ETFs playing a role going forward?
Yeah, I mean, when it comes to the defense contractor type companies, whenever global uncertainty and risk is higher, those companies are probably going to be fairly stable investments. They're traditionally not aggressive investments. If you're investing in defense type companies, they're typically good dividend payers, more stable companies. And in an uncertain world, it's hard to argue against owning stocks in that sector as part of a diversified portfolio. You kind of know defense spending isn't going down when Europe is increasing their defense spending. That's kind of the ultimate signal that there's global uncertainty. So definitely they play a good role in a portfolio right now.
Outstanding. Thank you so much. That's it. We're out of time. Robert, again, thank you guys. Thank you to City National Rochdale, the whole research team that you have. Emily, thanks always for putting these on and just helping us stay in order and keep in line and keep on time. If you've got questions out there, or if there's anything that comes up or questions that come up after this, always feel free to reach out to any of us here at Eagle Wealth, your direct financial advisor, Chad, myself, and I'll, obviously in any instance, we can also get questions relayed to Robert as well. So again, thank you for joining us today. Great way to spend the first week of the new quarter, and we'll look forward to seeing you guys, everybody join the call later on this year. Emily?
That's it. Again, we'll have the recording and the presentation slides sent out on Monday's newsletter. Again, thank you all. Have a great rest of your day.
Have a great week.